Hi, this is Alan Moore, Certified Financial Planner and founder of Serenity Financial Consulting. Thanks for joining me. Credit scores are becoming increasingly important. In the past, they were really only used for home mortgages and car loans, but now they're being used by life insurance companies and even potential employers. In fact, one study shows that 60% of employers were checking at least some of their job candidates' credit histories. It's incredibly important to know what's in your credit score and how it's determined. There are really 5 factors that are used to determine your credit score. The number one factor is payment history. This accounts for 35% of your score. Are you paying your bills on time? Creditors want to know how timely you are with making payments. If you're consistently 30, 60, 90 days late, they're going to be less apt to loan you money and to make credit available to you. The second most important is outstanding debt. Creditors want to see if you've been a good steward of your usage of credit in your past. So, for instance, if you have $30,000 of available credit and you've used $28,000 of it, then it's going to be looked upon poorly. The third important piece is length of credit history. Creditors want to know how long you have been borrowing money. Now, it's really hard to affect your length of credit history because you can't go back in time, but what you can do is be sure you do not close your oldest account. So your oldest credit card, that one you might have gotten in college because they offered you a free pizza, keep it open. Use it once a month, keep it active, because having that on your credit report lengthens your credit history. If you cut off that credit card or let it be cut off by the credit card company, then you're going to lose that length of time on your credit report, and it could actually hurt your score. The fourth important factor is new credit. If you're applying for a lot of new credit accounts all at once, that is going to really affect your credit score, because creditors don't want to see you taking out 2, 3, 4 new lines of credit all at once. It indicates that there's something maybe going on that they don't know about that makes you a higher risk borrower. The fifth, and really it's the least important factor, is the various types of credit. It supposedly only accounts for about 10% of your score. What this kind of refers to is that they want to see that you have multiple types of credit. So instead of having 3 credit cards, they'd rather see 1 credit card, a home mortgage, and a personal installment loan. This is very important when you're younger and have a shorter credit history. But as your credit history gets longer and other things start taking a little more, they just become more important, and this factor becomes reduced. So when you think about these factors, you can think of them as, if you were going to loan someone money, what would you want to know about that person, particularly if you didn't know them? Okay, you'd want to know, do they pay their bills on time? Have they been a good steward of their credit over time? How much of their credit are they currently using? How long have they been borrowing money? Are they taking out a lot of new credit accounts recently? These are the types of things you would want to know if you were loaning someone money. So the most important thing is to pay your bills on time. Always always be a good steward of your credit. Don't use all of your lines of credit at any time. You don't want to get yourself in over your head. And that will help to basically protect your score. So what do you think? Have you ever been turned down for a job due to a blemish on your credit report? Have you ever been told that there's another factor besides these 5? If so, feel free to comment below. Thank you so much for joining me.